Welcome back, everybody. We are here for another one of your questions about work. And the reason I paused there for a second is that one of the topics that we often end up talking about with work has to do with something you earn at work, which is money. And so we're going to cross a little bit into talking about your money, which is a theme that I think we'll talk about from time to time here. And for those of you who are here for the first time, I'm Roy. I'm a startup investor in the future of work, run Bloomberg Beta. And I'm here with one of my broader Bloomberg family colleagues. Nir writes for Bloomberg Opinion about a wide range of topics around the markets and the economy. He also has his own asset management firm, Unison. And so the question today comes from, especially now at a time when, privilege problems. Many people are in tech, at least, and elsewhere too, are earning money that they haven't seen before. Maybe they invested in crypto, maybe they were an early employee at something that's done well, and they hear all these different terms about different kinds of financial support. You know, they're private wealth manager. Well, what is that? And a private banker and a financial advisor. And it would be great, Nir, the question is, when should I hire a financial advisor? And it would just be great to hear how you think in general about how people should manage their own money. And thank you. It's so fun after getting to do some events to get to do this one with you.
Same. Yeah. Thanks for having me, Roy. So here's what I would say to people is I would think about financial advice, generally speaking, as being two different services. One is financial planning. For most people, that is going to mean answering basically two questions. How much money should I save for whatever my goal is, retirement, my kids' college, that kind of stuff. And for people who are older, how much money can I spend, and keep sort of my nest egg intact? That for the vast majority of people, those are going to be the two issues on the table. Then there's a whole other function, which is money management, which is I have money, I want someone to manage it.
Meaning I have my money that I've saved and I want it to get bigger via investment and money management, that kind of thing. Sorry, I didn't mean to interrupt you. Keep going.
Not at all. Exactly. Or I'm going to save money. Now, what do I do with it? Where do I put it? How do I invest it? And so on. Right. And what I usually say to people is for most people, they can do that stuff themselves. They don't really need to hire anybody. So, for example, on the money management side, the vast majority of people can have a great portfolio that will probably beat most money managers if they just buy basically two funds, a broad global stock fund and a bond fund, just to put in to sort of hedge the stock risk for their taste. That'll cost you probably 0.03, 0.04% of your money. Let's just call that free. You stick it in there, you forget about it, you let it do its magic, it'll grow, it's all good, you don't have to pay anybody anything. On the financial planning side, it's the same sort of thing. Financial planning to me is a lot like any other question of who you would hire. For example, should you hire a personal trainer? Well, if you're not going to do the push-ups and the sit-ups yourself, and you need someone to induce you to do it, then yes, hiring a personal trainer might be good. But if you can do all that stuff yourself, and you know what you have to do in order to get where you want to get, then it's not necessary to pay someone. It's really the same concept, both for money management and financial planning. If you know you need to save for your future, you should put away some percentage of your paycheck every month, or whatever, every year, every week. If you can get yourself to do it, then I think you can do it yourself. And I encourage everyone to try.
Well, I love the branching, and it sort of raises many more questions we can handle. And maybe we'll have to make this a series around financial planning and how does that relate to planning for taxes, and does your accountant do that, or do you get somebody separate? And estate, which I learned means estate is a fancy word for inheritance it's a shorter word, but somehow a fancier word for what you might leave your kids. So there's a whole branch there. Just sticking on the branch of investments, that almost sounds like maybe I should never have a financial advisor. And so are there circumstances, what does a financial advisor cost? And are there circumstances where I would want to stop self-managing and have somebody do it for me?
So focusing only on the money management for a minute, you do not need, as long as you can do what I just described, which is as long as you can put it in a couple of low-cost funds and leave it alone, you don't need to hire anybody. Unless there's a particular strategy you want. You're a geek about finance. You like a particular strategy. You found a manager that will give you that strategy. You're going to pay that manager. That's all fine. But most people don't have any preferences around this. They're not going to need anybody. Now, if you're going to seek somebody out, there's different levels of this. There are robo-advisors, for example, which you know well in your area. They generally charge somewhere between 0.25% to 0.5% of your assets a year. That's pretty cheap. Traditional financial advisors, the industry average is still 1% of your assets a year, which I would describe as very expensive. And I would tell everyone, find, if you're paying 1% on your money, find some other way to do it. A robo-advisor is a good alternative, but try it yourself.
Got it. And then maybe at some point we can get into sort of what for many of us is just imagining some possible future of what it looks like at the very high ends. Because one of the things that I've seen is you have these family offices almost that, sometimes for one family and sometimes for several of them, take on money management, but also like paying the bills and making sure that the legal documents move when you invest in something that's unusual, like a venture capital fund, for example. And I think this is like the perfect, we're able to just give you a table of contents, I feel like, and we can go from there.
Yeah, I mean, I would just add, I don't know how much time we have, Roy, but the one thing
please.
Well, the one thing I would add to that is it's useful, I think, to distinguish between the portfolio that I mentioned, which is the two fund portfolio, right? The simple broad stock market, broad bond market, and what a family office would have. What's the difference? A family office would have venture capital, probably private equity, hedge funds, investments in real estate and like energy and other stuff, other like hard assets and all that stuff. The question you should ask yourself is that portfolio going to do better than the simple two fund portfolio that I mentioned? And chances are, over the long term, over the course of an investing career, probably not.
Yeah. I mean, many of the people who honestly do that, I think, are doing it not because they believe it's the rational way to optimize their money, but it's just kind of part of how they live their life. Like, I'm a tech person and I'd like to invest in startups. Okay, well then I got to start, handling legal documents of being an angel investor or investing in a fund or that kind of thing. And then, I do think there's a kind of an asterisk that we should put on this for the future for certain investment opportunities that are only open if you're an accredited investor. That may, in theory, because it's only open to some people, it should maybe outperform because there's less supply of capital for it in theory. I don't know. This is me theorizing about something that my last knowledge of was like a graduate school economics class. But it does seem like almost all, I mean, look, if all you did was buy Facebook, Amazon, Google, Netflix, Microsoft, you would have outperformed all but the very best venture capital funds. And anybody can go do that with their discount brokerage account. So Robinhood or Charles Schwab or whatever, let alone a more balanced portfolio that, as you said, is going to be, outperform over the long run.
Well, the beauty of it, Roy, is if you bought that broad market fund, most of that fund, well, not most, but a plurality,
but a lot of it would have included exposure to those companies.
Yeah, 25% of it would have been the companies you just mentioned.
Totally.
Now, that's an unusual amount of concentration, but I mean, the market is really smart. It'll do that for you.
Yeah, I love that. All right. Well, thank you, Nir. And I feel like this is definitely one of these where it's like, okay, we did one, but now you just convinced us we need a whole chapter on this. And so to be continued. And for those who are joining us for the first time, the reason this is not advice, well, in this case, it's especially not advice because I don't know, Nir, I don't know about you, but I'm certainly not qualified to give you financial advice. But the reason we say it's not advice is because we're just offering perspectives of people who have different views personally. And then ultimately, you got to make your own choices about what you want to do.
That's well said.
All right. Thank you, Nir.